Hi, IBD. I'm Meredith Heyman. This is IBD Explains. Thanks so much for joining me. Who will win the election and what will that mean for your taxes? And depending on which party dominates the White House, the Senate, and the House of Representatives, your taxes could go up, down, or somewhere in between. And how will all these policies impact investors and the market? Lot to talk about. Joining me to break it all down is Barron's market reporter, Jacob Sonenshine. Jacob, thanks so much for joining me.
Thanks for having me.
Absolutely. Let's dive in. If former President Trump wins the election, what are his plans and vision regarding taxes?
So it's almost like there are four scenarios and there's two scenarios for Trump. So let's start with one.
Okay.
You have a red wave with Trump winning and you have a Congress that is dominated by Republicans. In that case, you have closer to the full extent of Trump's policy proposals going through. He wants to extend essentially tax cuts that were originated in 2017 to individuals. This is stimulative. You have to see if there are added dollars to that, meaning an incremental cut to taxes. But this could stimulate consumer spending. By the way, that's very inflationary, and that's why the bond market, that's why Treasury yields are up a little bit. That's why you may not get as many Fed rate cuts, but that's not the worst case. That's not the worst thing for the economy because you do get good economic growth. It's probably a nice environment for economically sensitive stocks. It's probably a nice environment for banks, which would make more loans and lend at higher rates and all that. Now, that's nice, but Trump also does want to do tariffs. The reason that I think a Trump presidency is basically in the short term could cause a pop in the stock market is because even with tariffs, you would be doing a 10% tariff on some goods, but a very small portion of total GDP in the country, in the US, which is over $20 trillion every year. And I think he's talking about like 60% tariffs on Chinese goods, but that's an even smaller portion of the pie. So you're putting an inflationary burden on consumers for a small portion of the economy. It could have spillover effects, but I remember in 2018, tariffs didn't really hurt the economy by economic growth by more than a few tenths of a percentage point. Hurts margins for some companies that get hit on costs. Some companies can offset that with higher prices. Some can't. I think overall, a Trump presidency probably leads to a pop in the stock market, even though you have yields going up a little bit. Good for banks, good for industrials, good for consumer discretionary. Now, if you get a Trump presidency, if you get a Trump or a Harris presidency, but you get more of like a gridlock Congress, you don't get a red wave, you don't get a blue wave, we don't have any waves, which is not, the market doesn't want that. It creates volatility. The full extent of policies from either candidate doesn't really go through. And if I'm starting with kind of not a huge economic impact from most of the policies, and then the full extent of the policy doesn't really go through, then the market kind of just looks past that. And the market really trades more on the economy, corporate earnings, and the Fed.
Now, let's go back to the possibility of another Trump presidency. What about his plans for corporate tax rates?
Yeah. So, I mean, look, if Trump, lowers corporate tax rates, that's the type of thing that gets priced into the stock market very quickly. It's another, is it a red wave scenario, or it's another question of wave versus closer to a gridlock? If it's a red wave scenario, it gets priced into the market very quickly, and the market goes up. And it's not. I would say also, you might get more of a lift to smaller cap indexes like the S&P 600 or the Russell 2000, which are much more concentrated in the U.S. in terms of revenue and earnings. The S&P 500 is about 40%, maybe a little bit more weighted towards overseas in terms of revenue. So, again, it's like you would take the full impact to earnings and then you'd multiply it by 0.4. So it wouldn't be the biggest impact. And then there are other factors, of course. How's the economy performing? Where is inflation? What are the other policies doing to inflation? And what's the Fed going to do with rates? And the market will always be very, very focused on that, especially if you don't get a red wave.
All right, let's move on to the potential of a Harris presidency and a Democratic wave and a blue wave.
Yeah, I mean, if you have Harris coming in, I think there are some positives because she wants to do things that would be sort of spending heavy. And then, of course, then you have to think about inflation, rates going up, fewer rate cuts from the Fed. But the trade-off is that the economy is in a good place. The Fed has made clear that it has the economy's back if needed. It'll get out of the way if there's too much inflation, meaning it won't cut too much. I wouldn't worry about that. There is some spending potentially from a Harris presidency. I don't know about the tariff situation with Harris. I think a Harris presidency near term on election day and for the coming weeks after the election would be less good for the market. It would cause less of a pop because let's talk about this blue wave, all out Harris policy type of situation. You have a rise in corporate taxes. So that would be something like 21% to 28% in terms of corporate taxes. What that does to earnings is it reduces your earnings by about 8.8%, but not really, because the S&P 500, again, so it's worse for small caps, but the S&P 500 gets so much of its revenue and earnings from overseas. There's a strategist at Citi, Scott Cronert, who reminds the market in a note, several weeks ago, you're probably getting a low to mid single digit hit to earnings for the S&P 500 because of its overseas exposure if you have a blue wave and a tax rate moving all the way up to 28%. I don't think it moves up all the way to 28%. I think you're going to get enough centrists in Congress that don't want to do that. Certainly, if you don't get a blue wave, we're not going all the way up to 28%. If you take the full extent of her policies on capital gains taxes going up by a similar magnitude, then your after-tax return on stocks would get hit such that the market would probably go down about 2 to 3%. Just to price in like, well, my after-tax return is a little bit less now. When I did math a few weeks ago, don't ask me to do math now. But that's the full extent of policy. But then I don't think that happens if you get something that's less than a blue wave. So it's another situation where I think if you're watching Investors Business Daily right now and you're going, are my stocks going to be moving around? Probably if you don't get a blue or red wave, they're not going to move that much, but they might move for a couple days because there'll be moments where it looks like we're getting something kind of wavy and then we'll get the results and we'll see.
More into a potential Harris presidency, tax breaks, the child tax credit, down payment assistance, small business credits. How will that impact the market?
It's another situation where it is stimulative, it is inflationary, quote unquote. And it's why the 10-year yield, and by the way, the 2-year yield, shorter term yields, which really track the Fed funds rate, expected Fed funds rate, it's why yields are up a little bit. I think the market is willing to take that. Yields have gone up with stocks in the last few weeks because the market knows that with inflation, you get better economic growth. And so the Fed would say, well, maybe we don't need to cut rates. But you want to watch out for that. I mean, inflation does become a risk if it gets out of control. And I would say we've talked a lot about the short term and how things are going to trade and how earnings would actually be impacted. And that actually matters more than the short term. But one of the biggest things long term, finally, it's great we're having like a nice 10-minute conversation, because I think what's really important that I haven't said yet in the last few weeks is that if the government deficit grows too much and there's too much inflation and rates go up, and we're already in a moment where price levels and levels of interest rates are high enough that consumers are like a little bit annoyed about it. You can see in the last few weeks of economic data, these are risks that are not great for financial markets long term. And I do think they should be addressed. It's just whether or not they'll be addressed depends on which people get put in place in certain offices and how the country is divided.
Right. And going back into the potential for a divided control with parties in between the White House, the House of Representatives, the Senate, over a long term, what's that going to mean for investors in the market?
I think what would happen if, again, in one of these blue or red wave scenarios, I think most likely you would get some incremental inflation. Tariffs are interesting because they lift the price of goods and services, but not because demand went up, which means that eventually demand would get hit. People would bid for fewer things, and then you get less inflation. But tariffs aside, if you get net incremental inflation from something really stimulative because there's a blue wave or there's a red wave, and you don't get like really balanced policy, you get some inflation. The Fed probably just doesn't cut rates as many times as it is on course to right now. And at some point, so the economy does fine, sales and earnings for companies grow, the stock market goes up. It's a little expensive now, but over the next couple of years, I think if the economy grows, it goes up a little bit. Also, the U.S. is very weighted towards technology, which is great. We have tech leaders in the U.S., and it pumps the S&P 500 higher as those companies grow. But at some point during the course of that little 1 to 2 year period where we continue to be in a bull market, the Fed probably goes, oh, we're getting some incremental inflation. We're not at 2%. We're hovering too far above it. And the Fed has to take care of business on inflation again. And then there's a whole deficit issue. So there are issues. I mean, and there are issues that investors will sweat about. But I do think that on balance, whatever outcome happens politically, I think the market continues to trudge higher, especially because the Fed has made clear that it will cut rates if it has to. Great for the economy. It won't cut rates if it doesn't have to. Means the economy is doing well.
Now, how can investors prepare for any potential market volatility, just reaction that we're going to see depending on this outcome of the election?
Look for something to buy, because when I see a company that where the stock is really getting hit because it's a company specific issue, it's not a macro issue. It's not, well, this industry will recover at some point. You really want to analyze that company and figure out how the complexion of its earnings and its growth trajectory has changed and see what's priced into the valuation. With something like policy changes, once the elections are over, presidential, Senate, Congress, everything, once everything is over, the market makes a decisive move if it has to make a move, and it prices in lower earnings if it has to, or it prices in higher earnings if it has to. If it has to price in lower earnings, let's call it blue wave. Harris comes in, big corporate tax increases, big capital gains tax increases. Market goes down maybe 10% on that. Like a 5%, maybe 4 or 5% hit to S&P 500 earnings, and maybe like a couple more percentage points because capital gains taxes are higher. And, maybe selling takes over. You get like 10, maybe 12% downside in the S&P. You probably want to buy it because that's the market resetting lower for earnings and after-tax returns resetting lower. And then it's off to the races with growth from that lower base of earnings. Why? Because the economy is growing and there will be stimulus. Whatever person is in place in the White House, they want to stimulate the economy. And that may have effects long term, but those policies are stimulative.
Yeah. And going further into the economy, the impact on these tax policies, how is that overall going to affect the broader economy, depending
Yeah,
on which way things go?
I think the big issues are inflation and deficit, and the deficit thing is so much harder to correct, and it's so much more of what we call a tail risk. A risk that could rear its head, but you don't know when, you don't know if, because most politicians don't really want to correct the deficit issue. But the inflation issue, if you get some incremental inflation from some sort of stimulative policy that goes through enough, the Fed probably just steps in and takes care of that. Issues that can be corrected by the Fed, the market can sort of absorb in time. The deficit issue is like sort of a tail risk, in my opinion.
All right, Jacob, we'll be watching. Thanks so much for joining me. This is IBD Explains. Stay right here on IBD for more. I'm Meredith Heyman. Thanks for watching. We'll see you next time.